Hello and welcome back to the channel. My name is Trajan. I'm the author of Morning Download, the personal finance newsletter read by over 100,000 readers. And today we're going to talk about retirement investments, the 8 things that you should not invest in if you are retired or near retirement. Not every investment is appropriate for every person, so I'm going to list out 8 things that you should not invest in. And the first one is high-risk stocks or penny stocks, because they can be highly volatile and lead to significant losses. And they don't provide the capital preservation or stable income that you need in retirement. Penny stocks are also prone to manipulation and fraud because they trade on different markets. So don't invest in penny stocks or high-risk stocks. Number 2 is complex derivatives and options. You may have seen ads for Forex trading and ways and programs that you can trade your way to a lot of money. But the truth is that they require deep understanding of these instruments and market mechanics, and often require a lot of leverage, which means that you can amplify your gains, but most likely amplify your losses or lose everything that you invest in these instruments. They are very high risk and not for everybody. And they're too complex for most people, especially in retirement. You have to be stuck to your screen, you have to be watching the charts, and they're not appropriate for shorter time horizons and lower risk tolerance. So if this seems appealing, remember that 95% of traders lose money. So it's only the very top percent of people that lose money, and they do it as a profession. So don't invest in complex derivatives or options. And if you do, make sure it's less than a couple of percent of your portfolio, because you're probably going to lose it. Number 3 is illiquid investments, like certain real estate, investing in private equity funds that may take 5 to 10 years until you can get your money back. So they tie up cash for a long period of time and may force you to sell if you've got a financial hardship, if a tree falls on your roof and you've got bills you need to pay. You can't get your money out very easily. Like in certain real estate projects, it may take years. It might take 6 months to sell a rental property, for example. And if you do have those kind of investments, make sure that you've got an emergency fund of at least 3 to 6 months of cash, and then you've got a portfolio of investments that you can also sell. And then lastly, you've got your illiquid funds. So make sure you've got your 3 buckets, which I talked about in a separate video, how to put your money into three buckets, and I'll link that down below. Number 4 is speculative cryptocurrencies. Maybe it doesn't apply to the top crypto. I've been in crypto since 2017. I think it's a revolutionary technology, but crypto as a main investment is not appropriate for everybody and not appropriate for retirees, because they are highly volatile and the market is largely unregulated, although that is changing right now. And it's too risky to have a large portion of your retirement in crypto. You can have some, if you put some in Bitcoin and some of the top cryptos, that can make up a portion of our portfolio, and several analysts and funds have shown that can boost your investments, but not as the bulk of your investments. It also is a complex technology and it's difficult for many to understand. So if you do want to have some exposure to crypto, then make sure it's one of the top 5 or 10 projects. It's not some obscure meme coin, because they're very risky and highly volatile and will probably be gone in a year or 2. So speculative cryptocurrencies, stay away from that. Number 5 is timeshares. Timeshare companies love to promote timeshares to retirees as a vacation spot, and you've got a place that you can always go to and you can pass it on to your kids and your grandkids. But the truth is that timeshares often decrease in value, and they come with ongoing maintenance fees. So it's not like you're going to just buy it and then just enjoy it for the rest of your life. You're going to pay ongoing fees. And then if you need to sell it, they are notoriously difficult to sell. They're very easy to buy. You just go and you sit through the seminar. They promise you all the things that are great about timeshares. And then when you want to sell, they're very illiquid. And if you do sell, you're going to probably sell at a loss. So we've covered the top 5. Are you involved in any of these? Do you agree or disagree? I'd love to hear your comments below, especially about timeshares. I know a lot of people get pitched timeshares. What do you think about timeshares? Number 6 is investments you don't fully understand. If you're investing in anything, whether it's a stock or a crypto or real estate or whatever, make sure you understand what the investment is. Make sure that if you can't explain it, then avoid it. A lot of complex investments entail hidden fees or risks that you may not be aware of. So make sure that you know all of the risks and all of the fees associated with any investment before you put money into it, because that lack of understanding could put your retirement savings in jeopardy. So make sure you understand. Number 7 is schemes promising unrealistically high returns. As the old adage goes, if it sounds too good to be true, it probably is. And retirees are often targets for these investment scams that promise high returns. And sadly, a lot of retirees fall for it. So don't fall for schemes promising high returns. And anybody that guarantees a high return should be viewed with increased skepticism. And number 8 is overly concentrated positions in a single company or sector. This is very common. You fall in love with your stock and you hold it for years, and then that stock may grow and it could become a big part of your portfolio. But the lack of diversification increases your risk. So even if it's a great stock, make sure you're diversified and don't hold a bulk of your assets in that one stock in case anything happens to that one stock or the sector. The stock has a rough couple of years, or just the whole sector that it's in has a couple of years. Make sure you're diversified in stocks and across sectors to help protect against risk. So if you like that, if you like those tips, then consider watching the next video that's related, and give this video a like and subscribe, and join the free daily newsletter morning download, link in the description. You can get the daily personal financial tips every day and stay up to date on the market by just going down and signing up for free. We'll see you next time. Thanks for watching.